Always good. This will be recorded and will be uploaded to our portal. It'll also be sent out tomorrow via email. But like I said, we've only done one deal in the last 24 months. We've certainly been trying. Only a handful have met our criteria, and we put offers on it, but someone was willing to pay more, and then we're okay with that. So, but we're excited, like I said, for this offering. And let me just read a disclaimer before we get into it. So bear with me. Uh, the business plan contains privileged and confidential information, and unauthorized use of this information in any manner is strictly prohibited. If you're not the intended recipient, please notify the sender immediately. This business plan is for informational purposes and not intended to be a general solicitation or a securities offering of any kind. The information contained herein is from sources believed to be reliable. However, no representation by the sponsors, either expressed or implied, is made as to the accuracy of any information on this property, and all investors should conduct their own research to determine the accuracy of any statements made. An investment in this offering will be a speculative investment and subject to significant risks, and therefore investors are encouraged to consult with their personal, legal, and tax advisors. Neither the sponsor nor their representatives, officers, employees, affiliates, subcontractor, or vendors provide tax, legal, or investment advice. Nothing in this document is intended to be or should be construed as such advice. The SEC has not passed upon the merits of or given its approval to the securities, the terms of the offering, or the accuracy or completeness of any offering materials. However, prior to making any decision to contribute capital, all investors must review and execute the private placement memorandum and related offering documents. The securities are subject to legal restrictions on transfer and resale, and investors should not assume they will be able to resell their securities. Potential investors and other readers are also cautioned that these forward-looking statements are predictions only based on current information, assumptions, and expectations that are inherently subject to risks and uncertainties that could cause future events or results to differ materially from those set forth or implied by such forward-looking statements. These forward-looking statements can be identified by the use of forward-looking terminology such as may, will, seek, should, expect, anticipate, project, estimate, intend, continue, or believe, or the negatives thereof, or other variations thereon, and or comparable terminology. These forward-looking statements are only made as of the date of this executive summary, and sponsors undertake no obligation to publicly update such forward-looking statements to reflect subsequent events or circumstances. All right. Another quick financial disclaimer. This business plan further contains several future financial projections and forecasts. These estimated projections are based on numerous assumptions and hypothetical scenarios, and sponsors explicitly makes no representation or warranty of any kind with respect to any financial projection or forecast delivered in connection with the offering or any of the assumptions underlying them. This business plan further contains performance data that presents past performances. Past performance does not guarantee future results. Current performance may be lower or higher than the performance data presented. All return examples provided are based on assumptions and expectations in light of currently available information, industry trends, and comparisons to competitors' financials. Therefore, actual performance may or most likely will substantially differ from these projections, and no guarantee is presented or implied as to the accuracy of specific forecasts, projections, or predictive statements contained in this business plan. The sponsor further makes no representations or warranties that any investor will or is likely to achieve profits similar to those shown in the performance or other financial projections. All right. We got through that. Thank you. So this opportunity, Cabo del Sol, is a deal that I bid on over 4 years ago, and obviously someone bid more than me at the time. A broker bought this to me off market in early June, and I told him my number that I'd be willing to pay. Since then, rates have gone down over 110 bips, which is more than the 50 bips that you've probably heard of, because it's different than the fund rate, as lenders were already pricing in the cut. The remarkable thing is I paid the same as what I told the broker, basically the same as what I told the broker over 3 months ago. We were patient and we let the deal come to us. In a time when cap rates are high in comparison to where they were, and interest rates have come down significantly, Now is the rare opportunity when the scales are tilted heavily on our side. Now is the time to take advantage of the small window. I truly believe that. Interest rates will continue to trend down and cap rates will compress as more buyers jump in. Prices will significantly, in my opinion, will significantly increase, in my opinion, which greatly de-risks our asset and improves our upside. This is what we've been waiting for. Even if interest rates don't go down further and cap rates don't compress, this is still a very strong deal. And we can't rely on what we think could happen. We can only rely on what is in our control. Over the next hour or so, Adam, Joe, and I will give you a brief background on BODC for those that may be new to us. We'll talk about the Tucson market, key highlights for the opportunity, our business plan, our numbers, and other key points. We'll happily take any questions at the end. If you have any that come up, please add them to the Q&A and not the chat so we can track it. And if you have any questions you think of later after the webinar, don't hesitate to reach out. We want to make sure you're 100% comfortable if you're interested in investing in our opportunity. We know that your time is valuable and you have investing choices, so we appreciate you taking the time to watch this webinar. This will be recorded and sent out tomorrow morning and uploaded to the portal where you'll also find the deck. So without further ado, let's jump in. So Breakup Day Capital focuses on only a few markets, so we could be experts in those markets, and that's the Southwest. Will be our 12th deal in Arizona. We've made bids in Vegas and Albuquerque as well. But other people outbid us, and like I said, we stay true to our criteria. We're not gonna chase deals, and that's why this will only be our second in 24 months. We were recognized by the American Apartment Owners Association as the best syndication company of 2022. We are the 25th fastest growing real estate company in 2022, recognized in 2023. Obviously, that number's probably gone much higher because we haven't been doing any deals because we just haven't liked what's been out there. And we've selectively acquired 1,600 plus units with a total value of over $280 million over the last 5 years or so. So this is very important to us. Our mission is to provide passive investors with superior risk-adjusted returns with the highest level of transparency and fiduciary responsibility while improving the quality of life and community for our residents. We try to create win-win scenarios, and that's why our residents stay over 20% longer at our properties than other properties compared to the national average. And as you can see, our core values: integrity, transparency, communication, diligence, and Kaizen. And for those of you that don't know Kaizen, that's constant improvement. So I've been a real estate investor since 2002. I've been an entrepreneur my whole life, and that's where my operational experience comes in. I wrote a best-selling book on asset management called Best in Class. Actually, I just spoke at a conference on asset management yesterday and spoke on a panel today at an IMN conference on value add. And speaking of value add, we've averaged a 40% bump in NOI over our portfolio in the first year of operation. So we do a great job of spotting opportunity. Most recently, I wrote a new book called Invest Smart, Spotting Red Flags in Real Estate Syndication. So check that out. You can get that on Amazon. You can go to our website as well. Certainly, there's been some bad deals out there, and we highly recommend you read that book. Previously, I owned a business where we ran after-school programs, outdoor ed, and leadership development. We are working with 9,000 students daily throughout Southern California. So really proud of that work. And I also formed a nonprofit. We have a great team. It takes a team to operate 7 properties that we own right now, to send out investor communications, to do all the back office, and I'm really proud of our team. I mentioned Joe and Adam earlier, but we also have on our team Sean, is our director of operations, Chad, who handles acquisitions and is our asset manager, and Jacqueline, who is makes all the magic happen behind the scenes to make my life, Adam's life, and Joe's life so much easier. So as I mentioned, asset management earlier, those are the copies of the two books. I have a podcast called the Real Estate Investor Podcast, and I speak at conferences throughout the U.S. I spoke at MFIN about a month ago in Denver. I'll be speaking at AAOA in about a month, and then also at IMN, the Middle Market Conference in Arizona in November. Like I said, we focus on the Southwest. We're not chasing deals all over the place. We want to be experts in a few markets. We want to build that data so we can make more informed decisions. We don't. We're just because deal flow slows down. We're not chasing car washes or other asset classes or other territories. Um, there's so much data, even when deals aren't happening, that we track, and that's why we just say hyper focused. We have great broker relationships. That's why this deal was brought to me off market. It eventually came on market. Went back to a different broker. That broker we've done 4 deals with. So we have really strong broker relationships. And like I mentioned earlier, thousands of data points that help us make more informed decisions. All right, I'm going to pass it off to Joe. Take it away, Joe.
Thanks, Gary. So an important aspect of asset management, which is something that we focus on tremendously, is executing on our value add business strategy. This is really what investors pay us for. What are we going to do to the assets to drive value, right? So we have something called BEAM, brand, exterior improvements, apartment interior renovations, and management operation improvements. So we have this programmatic way, and these are the 4 main areas that we focus on. And within each one of these categories, we have a menu of a myriad of improvements that we can make to the property. So just to illustrate, branding is really important. Sometimes people take it for granted, but when you come in and just even installing a new sign, changing the name so that it's our brand, we have Icon as our brand, and so we'll buy a property and then we'll change name to Icon on probably the street name, and why that's important is, and this doesn't show up on your spreadsheet, but why that's important is because you're basically announcing to everybody that there's a new ownership in town. We're going to do things a different way. You're going to see lots of improvements, and it's just it's like it's creating a whole new vibe. Um, Exterior improvements. These are things like just adding, amenities that it may be missing, just to kind of modernize them a little bit. It could be adding a dog park, adding covered parking with solar, maybe electric vehicle charging stations, or maybe uh, package lockers, as an example. Recently, we've been adding on one of our latest acquisitions. We've been adding these patios on the first floor units, that gives our first floor residents a lot more privacy, and they were willing to pay higher rents for it. Um, the interior, you probably heard some of the stuff before. Kitchens, bathrooms, new flooring, some of the trending stuff, maybe adding washer dryer, maybe adding a trash valet. You can literally, sometimes tenants are willing to pay a service fee for you to pick up they can just leave their trash in front of their door, and there'll be a vendor that'll come and pick that up. So there's all these different ways to add value, not only to the tenants, but to the property, and then ultimately to our investors. And finally, on the management side, operational side, Gary, as he mentioned earlier, he's always, focused on executing on Kaizen. We're just always finding ways to improve. Sometimes, for example, on our most recent acquisition, we were able to execute on a substantial water savings program that translated multiple millions into the property value, as well as I think we were able to get rid of one manager. I think the property was overstaffed and saved a bunch of money there. So just those are just some examples. And so by executing on this Beam programmatic business plan, and Gary mentioned this earlier, is that we saw an average increase of 40% increase in our net operating income in the first year of operations. That's really big. These commercial residential properties are valued like a business. So to the extent that you can create more income, the properties are worth more, regardless of what the market's doing. And so by increasing the NOI by 40%, let's say, by way of example, we increased the NOI from 1 million to 1.4 million. We have basically added $8 million to that property at a 5 valuation. Just some highlights from our operational history that we're frankly very proud of. We've had 4 full cycle exits averaging 49.5% internal rate of return. What's really interesting about that is we were able to do that in both an up market and a down market, and we'll get into in later slides. We've acquired over $280 million in real estate transactions. We have never issued capital calls, nor lost our investors' capital, lost any property to the bank. And knock on wood, that never happens. But we're very, we are entrusted with our investors' precious capital. So being good stewards of that is always, at the forefront of our minds. Although not our bread and butter, we've successfully executed on 2 adaptive reuse projects. And these were major deep value add transformations where we took a garden level office product and basically turning that into residential with the addition of 60 additional new units, which was basically 2 new buildings on the property. And then the other one was we took a defunct student housing, got down the vacancy, got to be really low. Or I should say the occupancy got down to be a really low level during the pandemic, and we basically turned it back into multifamily residential and got the lease back up. And then today we've distributed more than $23 million to our investors. And here's a snapshot of our current portfolio. The 4 properties at the bottom there, those are the 4 full cycle exits, which we'll get into it more granularly in the next slide. But the other 7 assets, and then soon to be an 8th with the acquisition of Cabo, you see that we have a variety of units ranging from 72, all the way up to 256 units. Purchase price, between $10 to $33 million. I'm sorry, $10 to $59 million. And these are your Class B and C workforce housing. They're all at various stages of executing on that Beam business plan that I mentioned earlier. And we're really just, trying to make improvements, every day, every month until the market is optimal where we would look to exit. One last thing, it looks like the property types are kind of all over the place, but as we rack up our track record, our buy box keeps getting more refined. And these days, we probably would not be buying the 72, or the 80 unit stuff unless they were going to give it to us. Okay. So drilling down further, just looking at our actual track record, and these are the 4 full cycle deals that we exited. You can see on average, we've exceeded our metrics we have exceeded all of our metrics. On average, we produced a more than a 2x equity multiple. That means for every $100,000 you invested with us, we gave you back more than $200,000. And that translates into an internal rate of return of just under 50%. And we did that in just less than 27 months, which far exceeded our projected holding period of, generally speaking, 5 years. Um, the other thing that's interesting to note on here is that if you just look at the last two deals that we sold on the bottom there, Midtown on Seneca and Midtown on First, what's really interesting about those two deals is that we sold one of those at the peak of the most recent peak of the real estate market, which was in the summer of 2022. And you see that when you got everything firing on all cylinders, we were able to achieve 101% internal rate of return, more than a triple of your money. On the other hand, we sold Midtown on First during, I guess you would call it a bear market. It's not quite the great financial crisis condition that we experienced, in 2008. But the Fed, by virtue of the way in which they raise interest rates so rapidly, it caused so much distress, for not only banks, but also many of our competitors. Even in that condition, we were still able to achieve a 19% internal rate of return and a 1.6 equity multiple over a 39-month hold, still exceeding our internal projections, even in a bearish market. So with that, let me turn the next few slides over to Adam.
Great. Thank you, Joe. So as you can see right here, Tucson, we get asked frequently, why Tucson? We've done 10 deals there. And these are just some quick stats about, Tucson. What's interesting about Tucson is it's the 33rd largest city in the country. As you can see, it's a large population. It's over 1 million people. But to me, the key number here is the median household income. As you can see, of December of 2023, it was 66,000. Let's just round it up to $67,000. So based off that, the largest rent in this new deal, Cabo Del Sol, for the 3-bedroom renovated we look to charge is $1,425. So if you apply, you take 1,425 and times it by 12, that comes out to about $17,000 of cost to a family. So if you apply that towards the median household income, you look at that Tucson's a very affordable city for working class people. That it's their rent's going to be less than 25% of their household income. So it's a very affordable city. And as you can see, it's a very large workforce of just over 506,000 people with a pretty low unemployment rate as well. So also what's very important to us is, Gary mentioned earlier, experts in the Southwest. And one thing that I think is very important too, why do we love Tucson? Why do we look at Phoenix? Why do we look at the markets that we look at? Is what's really important is economic diversification. That, look what has happened to certain areas of the country in the past. You have one city that's very dependent upon either one sector or even just one company. And if there's any downturn, that can decimate the entire city. So what's fantastic about Tucson is it's not just seeing great population growth and wage growth, but it's a very diversified economy over several sectors. As you can see, there's over 58,000 healthcare jobs, 20,000 plus finance jobs, aerospace and defense just under 20,000 jobs, over 34,000 manufacturing jobs. It's got the university, so it's a very diversified economy. So if one sector was to hit a down cycle or take a big hit, the jobs could easily be absorbed into the Tucson economy. Now, right now, at Break of Day Capital, we have two options. We're getting the details of our newest deal, Cabo del Sol, which we're going to rebrand to Icon in Midvale once closed. And we also have the Break of Day Capital Multifamily Impact Fund. Now, gladly go over which one's more suitable for you on an individual call. But snapshot wise, you really can't go wrong with either investment. They're both excellent investment options. But the big difference is the multifamily impact fund gives you just more diversification. If you were to opt to put your money into the multifamily impact fund, the way your money is divided is it's over the deals based off the capital raise. So just to keep them as simple, hypothetically, let's say Spanish Trail, the first deal for the fund, we raised 20 million for. Then Cabo del Sol, let's say the capital raise for that ended up being 10 million. And let's say the next deal was 10 million as well. In the multifamily impact fund, if you were to invest $100,000, $50,000 would go towards Spanish Trail, $25,000 towards Cabo del Sol, and $25,000 towards the next deal. Now, in the impact fund, you will get distributions according to your allocation along the way. And when each deal is specifically exited, you'll get your principal back and then the upside from the sale. So your money's not going to be locked in the impact fund until the very end. As each deal is exited, your allocated capital will be returned to you with the upside. Now, Cabo del Sol, our new deal, you can invest directly into this deal. As Gary said, we're very excited about this new deal, and we'll get into specifics later on in this presentation. But we love this deal that it's cash flowing from day one. We're targeting a 1.9 times equity multiple, and there's great upside, and we're purchasing in this property about 35% below replacement value. So two great options, and we're getting to that throughout this presentation. So the first deal in the Break of Day Capital Impact Fund is Spanish Trail. We purchased it. It was called the Place of Spanish Trail. We talked about branding, and we rebranded it to Icon at Spanish Trail. And this deal is doing fantastic. We purchased it at 33 million, which put it at just about 129,000 per unit. Renovation budget of 2.4 million. And always in our renovation budgets, we give a very big buffer there in case anything unforeseen happens. So it's probably going to end up being less than that. But a couple months ago, Gary approached me and my colleague Jacqueline and said, "All right, guys, I want you to do a case study on this property. I want you to let's find out how it's doing so far now that we've gotten several months of records." And what we found out was this deal is actually doing significantly better than we anticipated. Now, if you spoke to me about Spanish Trail, was one of the big points of this deal was the water savings. When we did the due diligence, we anticipated we're going to be able to reduce water usage. 50% was our initial estimates. And that was by changing toilet showers and faucets from high usage to low usage. Now that we've had this property, we closed it in December of 2023. Now, when I did this about a month and a half ago, the water savings was running at 75%. So even higher than we anticipated. So that our initial estimate was this was going to save the property $138,000. It's actually running towards $195,000. And that's going to boost the value of the property anywhere from 3.5 to 3.9 million. Now, how do we get a 3.5 to 3.9 million boost evaluation from $195,000? Is properties trade on a cap rate basis. So what a cap rate is you take the bottom line, the net operating income, and you put it over the price. Now, we purchased Spanish Trail at just under 5% cap rate, and we anticipate exiting at about a 5% cap rate. And so if you take 5%, so if you take $195,000 and divide it by 5%, you get to a $3.9 million boost evaluation. Now, Gary and our team, we're big believers in You want to underpromise, overdeliver. So we want to be a little conservative with this number. We also ran it at a 5.5% cap rate, and which turns out to be a little bit over 3.5 million. So there's a range here, but we took the low end of the range, the $3.5 million boost evaluation to get to our number. Two other things we did was the property was overstaffed. We were able to reduce payroll by $50,000. And also, there was an insurance claim against the property, which burned off. So that added another $50,000 to the property. So just by those three items, water usage reduction, payroll reduction, insurance claim being burned off, that is giving the property a value increase of $5.5 million, which, as I mentioned, as you saw on the one slide before, we raised $17.1 million for this property. $5.5 million divided by 17.1 gives you unrealized gain of 32% for this property so far. And there's still more things we're doing. We've when I first visited the property, the first 4 units had a nice little outdoor area, but I noticed the first time I visited the property that the tenants were not using it because it was just open to the courtyard. So we added little privacy walls to it. We all went to visit the property last week, and I noticed immediately almost all the tenants are now using that property. They all have either chairs outside, a little barbecue area. They're now using the space. So that's going to boost rent $75 a month when they're up for renewals. And there's still more things we're going to do. We're not really charging for pet rentals yet. But all in, the first deal, just based on the numbers in the case study we did, our investors are up 32%, unrealized. It's not realized until the property is sold. We're up about 32% year to date, and potentially even more now since we did this case study. So Cabo del Sol, this is our new deal in Tucson. And as you can see from the pictures just here, that great property and fantastic location. It's not uncommon for some multifamily properties to be in little rougher parts of town, but you can see from this picture, excellent part of town, and it's a beautiful property with great amenities. Now, this is the second deal for the fund, but we also mentioned that if you wish to, you can invest directly into this deal, entirely your decision. But this property it's 136 units. But to me, what's most fascinating about that, the units is the majority of these units are 3-bedroom. Of the 136 units, 80 are 3-bedroom. And all my years as a realtor in multifamily, I never came across a majority 3-bedroom property. I saw a lot of majority 2-bedroom, or even some that were all 2 bedrooms, but I never saw a majority 3-bedroom property. So 83 bedroom units, 32 bedroom, and 26 1-bedroom units. Now, it's great. What's also key about that unit mix with that many, 3-bedroom and 2-bedroom is, there's a huge demand, for workforce housing. We've talked about this in past webinars, that there's a shortage nationwide, but there's even a bigger shortage for 3-bedroom units for families. Working class families, need 3-bedroom units. So there's a lot of demand for these, and we're there to offer the supply to people overall. And usually when there's larger units, there's a lower turnover rate as well, because as we all know, moving is not fun. The current occupancy rate is in the low 90% range. Property built in 1999. So it's a much newer build than some of our other properties. And, for Tucson, 1999 is pretty new. Looking to purchase this property, we're purchasing this property, to say, at $21.1 million, which puts it a price per unit $155,000, which is, middle of the range right now. But we're also getting to, on a per square footage basis, because the units are so big, we're getting this at a very good price. And with that, I'm going to turn it back over to my colleague, Joe, who's going to go over the debt structuring.
Thanks, Adam. Okay, so I'd like to talk to you guys a little bit about the debt portion of the capital structure. Every savvy investor will want to know this really well, because you can screw up a good deal by putting on the wrong types of leverage. So what we're doing here is we're going to be using a 5-year fixed agency debt. It'll be interest only during the 5 years, and the rate will be fixed at 5%. So it's pretty plain vanilla. This is agency debt. I think it was Freddie, if I'm not mistaken. So it's pretty straightforward. We don't have to worry about rates fluctuating, and we were able to get interest only, so it really increases the property's cash flow, as we'll see in later slides. The total leverage for this property, the loan to cost, is a total of 74% all in. That's including all the renovation budget, operating reserves, as well as the soft preferred equity. And let me get into that piece a little bit more. So you guys know that preferred equity is not exactly debt, but we include it in the calculation just to be conservative. And this pref equity is an institutional partner of ours that we're very friendly with, and it doesn't have any foreclosure rights. They can't try to take the property from us, that you may have heard in some other situations. But this is just a friendly partner that we've worked with in the past that wants to write a single, $4 million check. And the interest rate's capped at 13.5%. Here's the full capital stack. As I mentioned, if you look at the senior debt, it's the agency 5-year fixed at 13. It's going to be just over $13 million. The soft preferred equity is the $4 million that I just mentioned. And then finally, the common equities where most of us are going to be in. That's the tranche that we're going to be investing in. So we're raising just a little under $6.5 million. To the right of the screen, you'll see the sort of the high level view of the use of funds. You see the purchase price at 21.1 million. The closing cost is a little over 700. CapEx is a little over 1.1, and that's the money that we're going to be using to renovate the remaining units and make improvements, and then also setting aside reserves for various components of the property. We're keeping a working capital of $350,000, and there's a fixed sponsor acquisition fee of 2%, and the total is just a little under 23.7. So why should you invest in this deal? Well, these are just some of the key highlights. First and foremost, you're betting on the operator. Gary and the team has shown time and time again that we are experts in Tucson. This is our market. This is our 10th deal, and we have 2 other properties within 4 miles of Cabo. So we know this market really well. The returns are pretty attractive. We're targeting a 20% average annualized returns. So, roughly a doubling of your money in 5 years. Of course, we'll try to do it in less, but that's kind of the projection. What's really interesting about this deal is that you will see strong cash flow day one. The way that this deal is structured, with the 5-year fix at 5%, and the fact that the going in cap rate is much higher than 5%, we are going into this deal with positive leverage. This is like, we haven't seen stuff like this in years, right? So you can expect to receive a cash on cash, in kind of the 7% range, and it will be towards the high single digits during the entire 5-year hold period. We're also buying this deal at a great cost basis. It's 35% below replacement cost. The reason why this is why we're able to secure this deal is because the market is transitioning from a cap rate expanding environment into one that is a cap rate compressing environment. Okay, so we're at that transition, and this is just a fancy way of telling that we're going from a low valuation environment to a higher valuation environment, and that's why we're also excited about this deal, because there's going to be a lot of tailwinds behind us. Now, despite the fact that this property is relatively stabilized, as you see with the strong cash flow, there's still opportunities for value add. We can renovate the remaining units. There's various operational efficiencies that we can also fine tune to improve the NOI. And lastly, and probably one of the most important, is that at least with us, the sponsorship team will always have plenty of skin in the game. We always make sure that we have a lot more to lose than anybody. So the team is going to be investing our own money, and Gary's probably going to be he's always leading the charge. So he'll probably have lots of his own money in this deal, like he always does.
So what's important to us with any property we buy? We want to make sure there's a good community around it. And so the Starbucks you see is very close. We got that Tucson Spectrum where the shopping, Harkins Theater, Target, Best Buy. We did due diligence. I was there twice that day, having a lunch and dinner at the restaurants there. You've got the Walmart, two Walmart supercenters pretty close by. It's 10 minutes from downtown Tucson, close to the freeway, and like we mentioned before, close to two of our other properties. So conveniently located. Adam mentioned before, lots of three-bedroom units. So here's just a snapshot of the unit types. So 81% of the units are two or three bedroom, which is huge. That means higher rent. Residents typically stay longer for the bigger units, and our rental rates are uh, um, very attainable for our residents. We're going to improve 38 of the units will upgrade, so not a big lift as some of our other projects, but tremendous cash flow, and we'll get into that later. But there is some value add to improve the look of the property, finish up the remaining units, and update the landscaping, add a barbecue area to the property. Here's some rent comparables. Like I said, we're on the lower end of the properties that are within 2 miles of us, so there is room to grow, but we're not going to be realistically raising the rents drastically. We have 0% rent growth in year one, and just under 3%, so 2.85% in the second, third, fourth, and fifth year, which is below what has been predicted for that area, which is close to 3.5%. So we always err on the side of being conservative. I know everyone says that. We built that into a number of different areas. We'd rather underpromise and overperform. Sales comparables. These are not much that sold in the last few years in Tucson. In 2022, there was 28 deals, 100 units or more that sold. Last year, only three, and we bought one of them. That's Icon on Spanish Trail, which you'll see. That was a 1979 build. It's the first deal in our fund. We paid just under 129 a door for a 1979 build. So really love that basis, and that's why I love our basis right now on this deal. 1999 build, $155,000 per unit, which is really good compared to some of the others. So um, you'll see peak at Oro Valley, a little nicer area, but $182,000 per unit. You can go down on the bottom to Juniper Canyon, a 1985 build, really rough area. It's $140,000 per unit and $251 per square foot, and we're call it, round up 179. So really like the basis that we're getting this deal. It's like I said, it's the newest property by far compared to the others on this page. So here's our renovation budget. Like I said, not a huge lift. That's why it's a significantly smaller reno budget than compared um, to Icon on Spanish Trail. It's a newer property too, so it doesn't need as much like reserves and stuff like that. But we still have plenty in reserves. We'll change the signage because we'll go to Icon on Midvale. We'll do some landscaping. We have some money for some barbecue area and some pergolas and just some extra money in there for things that pop up because things do break, and so we want to be able to use our capex budget versus take it out of cash flow. Here's our pro forma. We're really not moving the needle much from where it was. There's some opportunity because they had a bad property manager in there. It's the same property management company they have now that we're going to be using, but they had a bad property manager in there for a few months, a little bit back, which hurt their other income and some of their expenses. But our expenses are more than what they had previously in the past 12 months, and we're pushing up the income line a little bit. That's on some of the renovations that we do over time and some of that other income that we can capture. But nice steady growth if you look at over the 5 year. Nothing, we're not looking for a major driver of NOI.
So the investment classes. If you choose to invest with us, we give you 3 different investment classes, and this is for both the Break of Day Capital Impact Fund and also for our new deal, Cabo Del Sol. So Class A, which we call the preferred equity class, minimum investment 100,000. If you opt for the preferred equity Class A, you get a 10% preferred return. So what that means is your $100,000 investment, you'll get an annual return of 10% with a monthly distribution. And when the deal is exited, you'll just get your principal back. So this is like owning a bond that gives you a 10% return on an annual basis. Now, Class B, which is the common equity class, minimum investment of 100,000, there is a preferred return of 7%. Now, what I remind people is, although we expect to achieve this, and I'll get into next slide or two, we're going to go over to the expected returns. Always like to remind people that a preferred return is not a guaranteed return, but what it is a hurdle. That Break of Day Capital must pay you a 7% return each year, and it accrues. And if you've not gotten this when the deal is exited, the difference is made up. So when the deal is exited, you get your initial principal back, the 7% preferred return. If there's a variance there, we make it up, and then we get into the profit split. So it's very important that there's always preferred return because that means the operator and their team are motivated and must get a certain return for you first before they share in any of the profits. So after that 7% preferred return is achieved, we go into the waterfall. Now, for the Class B common equity, it's a 70-30 waterfall, 70% to the investors, 30% to Break of Day Capital, until a 15% IRR is achieved, and then it's a 50-50 splits. Now, we mentioned with Cabo Del Sol, this deal is giving great cash flow from day one. We're anticipating a 7% return year one, increasing each year. That number will be given to you on a quarterly basis. So if it was a $7,000 return, that would mean a $1,750 distribution to you each quarter of that year. Now, also in the Class B, you get bonus appreciation. Now, if you're not familiar with bonus appreciation, this is a great tax benefit that you get when you invest into multifamily real estate. So bonus appreciation, when we purchase a property, we have an engineer and CPA visit the property. And what they do is they look at the property and all items that could be depreciated 15 years or less they depreciate all of it the first year. Now, at one point, bonus depreciation was higher, was maxed out at 80% in 2023. It's maxed out at 60% for this year. But we anticipate bonus depreciation for this deal is 46%. So if you invest $100,000 into Class B, you will get $46,000 of passive income losses on your K1. Now, you can apply any passive income you receive towards that to avoid paying taxes on it. So let's say you have a rental property, or if you a vacation home that you rent, or if you're involved in, have a passive stake in a restaurant, all that income you can apply towards this bonus depreciation to avoid paying taxes on it. And what's also important about bonus depreciation is it's not use it all year one or you lose it. It carries forward. So if we close on this property as expected December of this year, and let's say you only have $10,000 of passive income you can apply towards it, the remaining $36,000 you can still have in future years. And that's one of the things that we as a team really love about multifamily real estate investing is, unlike a lot of other investments, there's great tax benefits, and bonus appreciation is one of the biggest ones. So for the Class B common equity, we discussed before, the average annual return we anticipate is 18% for this common equity class. Now, we also have the Class C institutional class. Now, minimum investment, $1 million. In this class, you get an 8% preferred return. So the preferred return is slightly higher. And after that is achieved, the waterfall is an 80-20 split. 80% to the investor, 20% to break of day capital. And like with the Class B, you get the distributions on a quarterly basis. Same percentage of bonus appreciation, 46%. And we forecast an average annual return of 20% for this investment class. Now, the sensitivity analysis. Now, this I found quite fascinating when I spoke to my underwriter team member Chad about this one. Is we told you before we're targeting a 1.9 times equity multiple for this deal. Now we came to this number factoring in economic vacancy and the exit cap rates. So we circle the 10% vacancy rate because to get that 1.9, Gary mentioned before, we run our numbers very conservatively. So for that 1.9 times equity multiple, they're applying a 10% economic vacancy number. So that's extremely conservative. And also the residential exit cap rate, we're pricing in a 5.4% number. Now, before we talked about Spanish Trail, we mentioned that number for that deal, we're targeting expected exit cap rate of 5%. So there's a very good chance that these numbers end up being extremely conservative out there. And as we mentioned on the bottom there, that Yardi reports the average vacancy rate of 8% in the submarket conservatively. So we wrote this sensitivity analysis extremely conservative. Now, the projected returns here. Now, this gives you an idea of what to expect if you were to invest in the Class B. Now, we always like to keep the math simple. So this is based off $100,000 investments. If you want to invest $100,000 in the Class B for Cabo Del Sol, we mentioned that this deal is giving a great cash flow and cash on cash returns from day one. So our projected distribution the first year is $7,000. As you can see, sort of in that grayish blue on the bottom, cumulative returns of $7,000. And year two, we expect that to uptick to $7,500, a 7.5% return, which would give you a cumulative return of $14,500. Picking this up to $8,000 or 8% in year three would give you a cumulative return of $22,500. Year four, we expect this return to pick up even higher to 8.6%, which would give you all in all a cumulative return of 31,100. Now, year 5, year we expect to exit this deal. As we mentioned, when we exit a deal, the first thing that you get back is your initial principal. So you get your return of capital of $100,000. Now you add that $8,900 to the $31,100, you have in all received $40,000 of cumulative returns from this deal year 5. Now, in addition to that $40,000 of distributions you've received so far, we expect proceeds from the sale to be $50,000, which would give you all in all return of $190,000. So 1.9 times equity multiple for a property you've held 5 years. Now, at Break of Day Capital, Gary talked about our core values. We all consider ourselves extremely fortunate and are very big believers in investing in the future and giving back. And here are just some of the organizations that we donate to. Operation Underground Railroad, which helps stop human trafficking, helping our veterans. Education, MBEF is a Manhattan Beach Educational Foundation, and Resident Relief Foundation, the RF, which helps people in economic difficulty, helps them pay their rent. Now, testimonials, I know this is small print, tough to read, and not going to read these verbatim, but one thing that's really important about Break of Day Capital that we're very proud of is of our investors, over 60% have invested in 2 or more deals with us. So our investors, stick with us and continue to invest with us. I know Joe here has invested in 6+ deals with us. So our investors stick with us, after each deal. So the timeline. So this deal, Cabo Del Sol, and also obviously the Impact Fund, they're open for investment now. We anticipate the deadline to be November 25th with a targeted close date of December 3rd, so early December. So that's a timeline for Cabo Del Sol. Now, when Gary went over our values, one thing they talked about was transparency. And I think this is one that I think is extremely important because, with real estate, your money is tied up and you want to be kept in the loop. And that's something that we're very big believers in. So one thing that we do is on the 25th of every month, we send out a monthly newsletter, email. And what's great about this newsletter is on the left side of it, it tells you how the property is doing specifically that month. It gives you the numbers. So it shows you the actual numbers, our pro forma numbers, and the variance. Now, on the right side, it shows you how the property is doing from the day we closed on the property. We call it ITD, inception to date. So it shows you, again, the actual numbers, pro forma, and the variance. So with this, you can see how the property is doing. And if the property had an exceptionally great month, we tell you why. Usually, vacancy or there's some other revenues came in. But if the property had a challenging month, we tell you, what happened. Was there an uptick in vacancies? But more importantly, the remedy, what we're going to do about it. We let you know if the properties, had that tough month and what we're going to do to fix the problem. Up the marketing budget, hire additional staff to give tours at off hours. Whatever it is, we're going to tell you what we're doing so you're kept in the loop of how your property is doing, both that specific month and how it's doing overall. The financials, we upload to the investor portal on a quarterly basis. So on a quarterly basis, you will see the rent roll, the profit and loss statements. And your K1 is uploaded annually on March 31st. But in addition to all this too is, Gary once had me as a guest on this podcast and asked, what's important about investor relations? And one of the things I told him is accessibility. So Joe and I, the investor relations team, we're here. So we're always here, and our goal is to get back to everybody, hopefully within the hour, but worst case, by the end of the day, if you reach out to us, is our timeline to reach back to you if you reach out to us with a specific question. So the highlights. As we mentioned, we are experts in the Tucson market. This is our 10th acquisition in the market. And we have properties nearby, so we have great economies of scale in this area. We're targeting an average annual return of 18 to 20%, which is a huge number. Cabo Del Sol is cash flowing from year one. There's immediately great cash on cash returns for this property. And at our price that we're acquiring this property is 35% below replacement cost. And there's still value add potential to this property. We talked about, management and efficiencies there. So there's some great value add potential as well. And as we said before, as Joe mentioned, that we're investing alongside with you. Gary's an institutional investor in our deals. The team is. And one story I'll share with you too is one investor not too long ago called me, and he had some issues with previous sponsors, and mentioned, he goes, well, they, if something goes wrong, you guys are fine, and I'm out of my money. And I had to correct him and say, wait a minute, no, that's wrong. And he's getting back to me like, what do you mean? What do you mean? I said, we're investors too in these deals. We have skin in the game. If something was to happen in one of our deals, we would lose out too. So we are investors in the deal, investing right alongside with you. So the next steps. So before I go over this too, I know we're about to answer questions, and you guys have been great. I see the Q&A box. There's many questions in there for us to answer, but please go ahead and type your questions in the Q&A box, and don't be shy. I tell people, we're here to answer your questions. We want you to be as comfortable as possible and excited to invest with us. And there's no better way to accomplish that by answering your questions. So please don't be shy. When I join Break, whatever question you think you're worried about asking, trust me, it's been asked before. Somebody else is wondering it. And I personally have probably asked it. When I joined Break of Day Capital, I can't tell you how many questions I bombarded Gary and Joe with. So please don't be shy with the questions. So your next steps to invest with us, you can scan that QR access code right there on the screen, or you can go to our webpage, to our investor portal there. So that's the first thing you do. And then all the documents are there. Read the documents, follow the e-sign instructions, the documents. And once that's done, within 3 days of the approval notification, you wire the funds. And also just want to mention tonight, if you do want to talk some more, my email's right there. I know it's very small print, but my email is an easy one to remember, adam@breakofdaycapital.com. And my telephone number is right there too. I know it's very small, but it's 602-529-2056. You can call, text, email me, whatever your preferred method of communication is, if you'd like to schedule a follow-up call. And if you do choose to invest with us too, I highly recommend you do that. Call, text, email me, let me know. And we're there to help you through the investment process step by step. It's always good to reach out to me and say, I'm looking to invest this, and we can help you with the process from that point. I'm going to turn it back to Gary. I see there's a lot of questions we're here to answer, but again, don't be shy. Please ask your questions. We're here to answer them.
And to clarify, the documents to invest in Icon on Midvale, they're not available yet. That'll be about a week or so. But the webinar will be posted on the portal by tomorrow morning. The deck is up there now, and you can invest in the fund right now if you'd like to. So our first question is, do you provide potential LPs with your underwriting assumptions and rent survey analysis? We can share that. We won't give you like our whole underwriting. I mean, that's a beast of an Excel with many tabs, and we spent tons and tons of money building it, but happy to share some of those assumptions and analysis. Next question is, what is Gary's team's track record in terms of number of full cycle deals as a GP, not an LP, and that's what we included. So on the deck, you'll see that it was Joe went over that earlier, but definitely go back to the deck. You'll see that what we've done as a team. We've had 4 full cycle exits so far. We'll be exiting investors out of another deal shortly, our Youngtown project. Hopefully, once we refinance that loan, but you'll it's in the deck. And a shout out to our book that thank you. She writes Invest Smart is a very good book. Well done. So thank you. If you're new to investing in real estate syndications, we highly recommend you check that out. Even before investing with us, get a understand the red flags. That'll really help you. We have a question here. When have you started New Mexico? Are there any upcoming opportunities in New Mexico? We've there just hasn't been many opportunities in New Mexico. We're looking at a deal there, but when we got this deal, we passed on that other deal. We've made offers on other deals as well. Someone was just willing to pay more. So we keep our eyes on the markets that we're interested in. We put all that data into our pipeline, and that helps us make better decisions in the future. We have a shout out to Adam. And yes, good question. Do you want to take the minimum investment, Adam?
Yes, the question is $100,000 the minimum investment? It is, but for sure, we can make exceptions. So if you want to invest with us, as I said, reach out to us and we can certainly talk about that.
Joe, you want to take the next one?
Yeah, I will. And let me just reread the question. Lu Feng said, Joe said that we are transitioning from a high cap rate environment to a low cap rate environment. Is it only because of upcoming interest rate cuts? What other macro factors are you referring to? So this is I love this question, and Gary and Adam can probably tell you that we spend a lot of time looking at macro stuff. And so that's part of the answer is that yes, it's part of it has to do with we're tracking the Fed's interest rate cutting cycle. We're trying to predict how many cuts there will be over the next couple of years. But not only just that, we're also paying a lot of attention to global liquidity, such as things like the global M2. And what that is every once in a while, central bankers around the world, they coordinate with further debasement of currency. So they all have to take turns printing more money. In fact, if you just scan the news the last couple of days, I think China just announced, I don't know exactly what, they were going to print like $500 billion or something like that. So if you just stuff like that. And the way to think about it is just imagine like a monopoly board, right? You only have so many houses and so many, green houses and red multifamily properties. But if you keep adding, more paper dollars, the property values are going to go up in dollar terms, right? So that's how we think about it.
We have a question here. Yes, it's a B class apartment. So Formica countertops. Uh, Asked when was the last time units were updated and renovated. Within, if units need to be renovated now, they get completely renovated. They've been doing that over the last 4 years. But if it's a unit that's in good condition, then they're not renovating those units. There's 38 units that have to be renovated still. And the question is there a return on investment on that? That's a good question. We haven't been able to get pushing those unit renovations at our other properties in the last 6 months, 8 months. We're starting to do that more now as we're heading out of a kind of lower return on investment but it's not something that we budgeted to do all now. It's something that will happen over time as um, as people leave those units, and we feel we can get that um, return on investment. So very, very good question. This isn't a distressed property. That was a question. Um, it's just a great time to buy, like I said, because um, cap rates are still high, but interest rates have come down significantly uh, in the last 10 weeks or so. So that's why it's such a good price. There was another deal they wanted to sell. Um, it was going to be a portfolio, and we went after both properties. It's an identical property, but because they didn't get as much money as they wanted, they ended up keeping that property. Um, so, certainly maybe 6 months down the road, 12 months, if they go to sell that other property, they're gonna make a lot more money because a lot more people are going to be entering the market. Cap rates will compress, interest rates will continue to go down, but that's why we're getting a really good opportunity right now. Um, the question is, who is your property manager? It's a Scotia Management Group. They were recently bought out by Avenue 5. It's still the same team. We've been working with them for a number of years. We really like working with them. So we have a team in place. Um, the question also is, what's their track record? I mean, all I could say is we have a great working relationship with them, and they've done a really good job with our properties, and that's why we like this property as well. They've been running it, well, too. So um, they're a great partner to have. We're not entering a new market. You'd have to establish a new partnership. Question is, if you already own Spanish Trail, what is the use of the new equity for the fund to replace the current partners, operating expenses, capex? No, this isn't for Spanish Trail at all. That's why we didn't keep raising in the fund. This would be an additional property into the fund. Spanish Trail is all taken care of. Adam, you want to take the next question? Do you send K1s every year? I hear a lot about LPs having to file for tax extensions because of the late K1s.
Yes, we do send our K1s on time every year, as the question said there. It said transparency is one of our values. It's in your investor portal, you'll have access to that. And yes, it is sent out on time every year.
Question is, do you accept 1031 investments? We do. It's got to be on the front end, and it's just so hard to time. We have a number of people that want to invest a significant amount of money, and I think they'll end up investing through the lazy 1031, which is a great way to go because through the bonus depreciation, you're going to save just as much money. You're not going to have to pay taxes because of that bonus depreciation. You're kicking the can down the road, and the timing is just always so hard to make it work. But if that's something that you have ready to go, we have a $750,000 minimum because of all the paperwork and all that's involved. But you really need to let us know now. Yes, we send monthly email updates for every property, as Adam said earlier, typically on the 25th of the month, and we talk about the good, the bad, and if there's any ugly as well. Uh, we have a question here. Does the pref pay out day one? Um, yes, the pref. If you invest in Class A, it's a monthly payment, I believe. Correct, Adam?
Correct. Yes.
And that gets paid out right away. Do you want to take? You talked about this earlier, Joe.
Yeah, I can do
Could you
that.
clarify what the actual debt to cost ratio is?
Yeah. So a lot of times, people just basically take the senior debt, just the bank debt, and divided by the purchase cost or the purchase price, right? So that, it's loan to value, right? Well, we wanted to be super transparent and basically um, show you that the way that we figure out the way that we figure out the loan to cost, which is everything, right? So the way to think about it is you take the bank debt plus the preferred equity, which is the $4 million partner that we have. Again, I just want to caveat that by saying that that's technically not debt, but very sophisticated investors typically try to add those two together because it really shows it really just for the sake of conservatism, we kind of add that into part of the debt. And then also as well as we include the renovation budget of $1,000,001 and some other things so that we have the entire cost on there. If you care, I can tell you that the loan to value, I think it's Gary, if I remember correctly, like it's in the high 60s, right? 67, 68 or something. If I'm, was
Yeah,
it lower than that?
something.
Or was it low 60s? But we feel that that's not an accurate, that number really doesn't really give you the full transparency. And Ramses, if you want to talk about it, let's just get on a call. Happy to catch up with you anyway.
We have a question here. Gary has 30 years of experience or something like that, but 4 full cycle deals. Operations experience. So I've been running companies even during college and since then. So I've been investing in real estate since 2002, but I started buying multifamily properties in 2019. What is the reason for current occupancy of 91%? Have you inspected the rent roll, and are there any bad tenants, evictions pending? I'm not sure if you're implying if the 91% is good or bad. We did walk every single unit during due diligence. That's part of the process. We have inspected the rent roll. And yes, every property you're going to have some bad tenants and evictions pending. That's normal on a 136 unit property. And that's just part of the business. That's built in, so when we say current occupancy, so economic occupancy is after you take out the any money that hasn't been received from bad tenants. But yeah, our property management company does a good job of making sure their tenants are good tenants. But yes, every once in a while, tenants lose their job or have something happen, and that's part of the business. That's the beauty of multifamily, because on a 136 unit, we can have a few bad tenants. No big deal. A few bad tenants out of 136, we're at 97% occupied. If you have a 4 unit and you have 2 bad tenants, you're at 50% occupied. So that is the beauty. Economies of scale. That's why we do this. Does the institutional class get the higher recurring cash flow, 8%, or do all classes get the estimated 7% payout day one? Yes, Class C does get the 8% pref return. So it all depends on our cash flow. If we have only 7% cash flow, then it's just accrued for the institutional class, the class C. So good question. Can you detail the fees, fund administration, property management, acquisition fees, etc.? So the property management company, we negotiate 2.75% rate, which is lower than usual. That goes to the property management company. We don't have like a 2 and 20 for the fund. We have the fund and the SPV. We have the same fees. We get a 2% asset management fee, and it's not double. It's just for the income of the property, and that's it for the property. And then we do have the acquisition fee, which you'll see earlier in the deck. That's 2%. And there's no other fees. Investors get paid back first, 100% of their money, the pref, and then we go to our split, and then the waterfall for the Class B. So we're highly incentivized to perform well as a company, and then like I mentioned earlier, many of the team also invest in the deal. I'm an investor, so hope that answered all your questions regarding the fees. Oh, the one other fee, construction management fee. Again, that goes to the property management company based on managing the the capex piece. So how much space is available for Cabo? We have 6.47 million available. We've had a lot of soft commitments, but we haven't opened it up for anyone to fill out the documents or wire in money yet. So the whole space is available currently. So the property management company, like I said, is Scotia, who is owned by Avenue 5. The property management company is different than the property manager. The property manager was someone that was in there a few months ago, that they had since fired, but um, uh, wasn't performing as well as they should have been performing. So they had lower income and more expenses because of that person. That's since been rectified. Um, and we can always change that person out, but it's the same property management company that we've been working with for years that we really like. So the question is, what is the target price on the sale? Um, Again, these are just projections, but our target sale price is just over 30 million. We're buying it for 21.1. So that's based on if we hold the property for 5 years. Thanks for the shout out, Michael. Great presentation, guys. Exciting opportunity. Appreciate that. Adam, you want to take the next question?
Sure. The next question is, do you allow investments from a retirement account? And the answer is yes. The one caveat there, though, too, is your 401k or IRA, it has to be self-directed. So if you have a company 401k, you would have to roll it over into a self-directed IRA. We've done that we've helped many investors through that process too. So it's not difficult, a little time consuming, but if you're looking to do that, for sure, we could definitely be of assistance.
So the question is, what do you like most about this deal? What do you like least? What I like most about is 7% cash flow. And I'll throw also in 1999 bill. Those are two things that got me really excited. I don't think we've ever had a deal cash flow 7% day one. So I know a lot of investors have been asking for a little bit more cash flow in a deal. So that's really exciting. What I like least about the deal, usually we do bigger value adds. It's not as much as a value add, but that's why you got the big cash flow. So it's we like to add in all of our creativity and really drive up revenue. That isn't the case on this deal. So I would say that's what I like least about this deal. Is there a market study done on new construction, single and multifamily, which is coming 1 or 2 years? Or is that already baked into our underwriting and economic vacancy? It's already baked in. The permits are out there. We can see they build very little in Tucson and also very little in this area. They built one property in the last year. There's some more new construction a bit north, maybe 20, 30 minutes north. There just isn't. And that's one of the reasons why we love Tucson. It's not. We also like Phoenix, but they also have 40,000 permits right now, and that's not the case in Tucson. Joe, you want to take the next question?
Yeah. So the question is, how many properties will end up in the fund? So in our mandate, we are targeting 3 to 5 properties. So this will be our second, and well, we were hoping we got the sister property, but
Yeah, we would have hoped to have filled it up by now, but we just haven't seen enough deals that we like at the price that we're willing to pay. So we're just being patient, and we don't. That's why we don't overraise too. We're not sitting on money. We're not forced to do deals. So we're just conservative. Can you provide crime statistics for the area and any trends noticed? Crime is trending down. Um, when you invest in a city, there is crime. I'm not going to say there isn't any crime, but we've been there during the day. We've been there at night. We have properties in the area. We haven't had an issue, um, and we feel very comfortable buying this property. All right. How do we get to see that you are also invested with skin in the game? Example, can we see transaction statements even if redacted? Um, good question. We're not going to set up a call with everyone and be like, "Hey, this is my K1 or something," but um, we can figure something out. But yeah, it's not just me. Like I said, we've had other team members invest in most of our deals. So, but we can have a sidebar about that. Um, Hypothetically, if we sold the property right now, what price can you command? We didn't get we paid market price, what the market was willing to pay for it. Someone wasn't willing to pay $1 million more than us, and we stole it. That they're not going to sell it to us that way. Um, so it's not what the price is now, but what the price is going to be in a couple of years from now. So um, we paid market. Um, if you were to build that new, it would cost significantly more than what we paid. Our residents typically car owners, and what is the walkability score of that area? Yeah, this isn't, Tucson has a very small downtown. This is a car city. Everyone has their own car. I don't know the walkability score of that area, but certainly you can walk to the shops there within I think a mile and a half. But driving around that city, you don't see too many people walking around. You'll see more of that like downtown. Um, and the last question of the night is a 36 question answer. What is the ranking of the school district in the Cabo area? Um, it's a Tucson school district. Any of these cities, not the greatest, to be honest. Um, it's never been a deterrent. I've done this will be my 12th multifamily property. As a GP, I've invested in many others. For the class that we're going for, it's Class B workforce housing. Um, if there's a number of good schools in that area, but if you wanted the elite schools, that's you're gonna go to a private school, or you're gonna go to an area north Tucson that's going to be a lot more costly. These are good schools for what residents are paying for their rent, but um, again, it's a big city school district, so they're not going to be the top rated schools that are out there. Well, thank you again for joining us. If you have any questions, feel free to reach out to Adam or Joe or myself. Um, we'll get the webinar out. If you wanted to rewatch anything, or if you came late, we'll have the deck. The deck is already up on the portal. And yeah, don't hesitate to reach out and ask any more questions. So thank you for your time.